You probably have seen the scary headlines around aggressive rate increases by the Fed, and the thumbnails from Graham Stephan and Andre Duke make it seem even worse. In this video, I'm going to break down what the Fed rate hike means for you and your money. And more importantly, what should you do about it? If you're not sure where to start, don't worry, we've got you covered. I'm going to explain everything in this video. So sit back and relax while I talk you through it. For those of you who are new to the channel, welcome. My name is Neera and I'm a financial analyst. I talk about personal finance and investments and teach you how to make money and grow it exponentially. If you're interested in this topic, consider subscribing as this will help the channel grow and impact more people. Before we discuss the implications, let's look at what is the Federal Reserve and which interest rate they are increasing. The Fed is the central bank of the United States. It controls monetary policy, the availability of money, and the credit in the economy, and regulates financial institutions. Its main goal is to promote maximum employment, stable inflation, and neutral interest rate. Since the Fed takes a long-term view, in the short term, these goals sometimes conflict with each other. For example, currently the Fed is technically trying to increase unemployment to battle inflation. In the short term, this strategy will have awful consequences for individuals losing their jobs. But in the long term, a lower inflation will create a healthier economy. The Fed influences these in two ways: controlling the money supply and setting the federal funds rate. Money supply is simply buying or selling debt instruments. When the Fed buys securities, it injects money into the economy and drives down interest rates, which is what happened during COVID-19 with interest rates near zero. Conversely, when the Fed sells securities, it drains money out of the economy and pushes up interest rates, which is what we're seeing now. Federal funds rate is the rate banks use to borrow from each other, and it serves as a benchmark for other rates like the ones you, me, and businesses use for loans. The Federal Reserve's Federal Open Market Committee, also known as FOMC, meets 8 times a year to discuss monetary policy and make decisions about the direction of interest rates. When the FOMC votes to increase the Fed funds rate, it will ultimately lead to high interest rates across the board. Rate hikes can have a lot of consequences for consumers. To put it in simple terms, when the Fed increases rates, it increases the bank's costs of borrowing, and these costs are transferred to you as a customer when you apply for a loan. So far this year, the Fed has increased the rates by 75 basis points 3 times, bringing the target to 3%, and will possibly reach 4.5% by the end of the year. The next meeting where another rate hike is expected to be announced is scheduled for November 1st, following by a last meeting for this year in December. It is yet to be seen whether the aggressive actions taken by the Fed were the best, and unfortunately, it's only clear in hindsight. Current inflation data has shown little to no improvement because the low supply that is affecting inflation the most is out of the Fed's control. For now, let's look at the consequences of these hikes for consumers. Number 1. Let's talk about the effect on the overall economy. When money is cheap, borrowing increases and drives up spending, and thus the economy with it. The opposite is true when the interest rates increase and make it more costly to borrow money. The idea is to bring the demand down so that prices will decrease and inflation, the biggest evil to help the economy, will go down with it. This leads to lower spending and declining economic growth because businesses don't expand and increase layoffs. This decreases consumer spending and economic growth. The problem is when these rate hikes are too aggressive, like the ones we're having right now, it may lead to a recession. Number 2, effect on the dollar. The Federal Reserve interest rates hike is usually good news for the dollar. That's because the high interest rates make the dollar more attractive to investors, who then buy more of the currency. This increased demand pushes up the value of the dollar. However, there can be some downsides to a strong dollar. For one thing, it can make imported goods to the US more expensive, which can lead to inflation. In addition, a strong dollar can make US exports more expensive and hurt American companies that sell goods overseas. Number 3, cash accounts. Savings accounts, money market, and certificate of deposits rates typically increase because of the tick-up of the rates. While that is true in theory, in practice it is not always the case. Surprisingly, the culprits are consumers themselves. Here's how. There is no incentive for banks to pay more for those deposits. Apparently, banks have plenty of deposits to cover their operations. As of June, they have a total of $19 trillion, which is more deposits than they want. So unless consumers shop around and move their money elsewhere, big banks won't nudge. And why would they? Pricing is driven by consumers' demand and competitor supply, among other things. For banks, the difference between savings rate they give to customers for their deposits and interest on loans they receive from the borrower is their profit. And no business would decrease their profit unless they have to. Therefore, it is your responsibility to take care of your finances and get the best return for your buck by shopping for another place for your cash. Opening a new account can typically take about 15 minutes of your time, yet bring you substantial returns. Another point to consider is, even though the rate increases, it doesn't increase enough to offset inflation. I've seen so far 2.5% on average, which is nothing compared to 8.26% of inflation. There are better alternatives to money markets and CDs, such as Series I bonds, treasuries, and other types of bonds that pay a higher rate. The downside is, of course, liquidity constraints that you will need to take into consideration. In addition, anyone with a debt burden should instead seek to pay off their high debts to offset the high variable interest rates tied to credit cards, home loans, or other debt instruments. Speaking of debt instruments, the interest on credit cards and consumer loans is directly affected by the interest rates that the Fed changes, since these are short-term rates. Bank will raise interest rates on credit cards in order to compensate for rising borrowing costs. So if you're carrying a balance on your credit card, a rate hike can increase your monthly payments and make it more difficult to pay off your debt. The average credit card rate was 18% as of September, up from around 16% in March when the Fed began its series of rate increases. I recently started receiving several letters from my credit card companies informing me about the rate increases. Just a month ago, it was 18%, well, 18.49%, and within a month, it increased to 19.24%. Another credit card went as far as to increase it to 29%. So again, make sure to pay off all of your high interest debts, as your interest charges are about to increase substantially. If you're not sure where to start, make sure to check out my video on strategies to help pay off your debt faster, and use the free template in the description down below to track your progress. Number 5, higher auto loan rates. If you're in the market for a new car, you can expect to pay a high interest rate on your loan. According to Bankrate, the average APR on a 5-year loan increased over the past 6 months from approximately 4% to 5%. Therefore, it is better to hold off on car upgrades, but if you absolutely need to buy a car, you should be savvy about how you finance your purchase. Negotiate your rates. Don't just rely on financing provided by the dealership. They are often more expensive. Instead, get quotes from other banks and credit unions, which can provide a more competitive rate. Number 6, higher mortgage rates. Mortgage rates don't move in lockstep with federal funds rate, but track the yield on the 10-year Treasury bond. It is used as a benchmark to measure the interest rates on other types of long-term debt, like mortgages. The yield on the 10-year Treasury bond is influenced by inflation and how investors expect the Fed to react to rising prices. When inflation is high, as it is currently, the yield on the 10-year Treasury bond tends to rise, and mortgage rates usually follow suit. The Fed also influences mortgage rates indirectly. This is done through buying or selling debt securities in the marketplace, which in turn impacts the yield on those securities. When the Fed wants to decrease the money supply, it sells securities off its balance sheet. This action drains money out of the economy and pushes up interest on mortgages. Number 7, the influence on stocks. As a general rule of thumb, when the Fed cuts interest rates, it causes the stock market to go up. And when the Fed raises interest rates, it causes the stock market as a whole to go down. In other words, when interest rates go up, it becomes more expensive for companies to borrow money. This can lead to lower stock prices as investors pull their money out of the market and put it into safer investments like bonds or cash. But there is no guarantee of how the market will react to any given interest rate changes the Fed chooses to make. The best strategy here is to stick to your portfolio and buy stocks and index funds if you think they're a good buy. Now that we've covered how federal rate hikes influences different parts of your finances, let's now discuss how to navigate this high interest rate environment. To sum it up, here are some tips on what you can do if you're worried about the effects of a rate hike. Number 1, review your budget and make sure you're not overspending. This is a good opportunity to review your finances and make sure you are on track. If you have any high interest debt, try to pay it off as quickly as possible. This could include credit cards, personal loans, or even car loans if the interest rate is high. Save more money by cutting some expenses and creating a savings plan and stick to it. Increase your emergency fund from 6 months to 8 to 10 months worth of expenses. Number 2, invest in assets that offer stability and security like bonds, treasuries, or cash accounts like money markets and security of deposits. Number 3, shop around for the best rates on car loans and other types of borrowing, and don't hesitate to negotiate these rates. Number 4, this is also a great opportunity to find good buys in the stock market. Remember that some companies are cheap for a reason, so try to avoid bad investments. This is the time where bad companies get worse and might even disappear from the stock market, along with your money. With a little analysis, you can find good investments and reap the rewards later. And finally, stay informed about how the rate hike will impact your finances and make adjustments as you need. If you like this video, leave us a thumbs up, subscribe to the channel, and make sure you turn on notifications to never miss out. Check out my other videos on the channel for other money-making ideas you don't want to miss out on. As always, thanks for watching, and I'll see you next time. I'm Stefan and Andre do. Andre do. What? Andre do. Committee, it's committee. Rates, no. They have a total of your time, yet give you, sure to pay all of your high interest, to pay off purchases. Now that we've